Hi, this is Kevin Kerr for Money and Markets TV. Last week, the International Energy Agency announced that it would release 60 million barrels of oil from the Strategic Petroleum Reserve onto the world markets. The announcement caused an immediate sell-off in oil prices, driving crude down about $9 in 2 days. But longer term, the move will likely have the opposite effect on oil prices. Think of it this way. The oil was released onto the market when prices were at about $90 a barrel. If prices rise, the IEA and the Obama administration will have to replenish the petroleum reserve at the higher price. And most of that oil will come from outside our borders. So it's obvious to me that this was just psychological window dressing, a desperate move by an imploding US government. It underscores how worried our leaders are about global economic growth and tight energy supplies. But essentially all they're doing is robbing Peter to pay Paul. And ultimately, it will be counterproductive. Because unlike paper money, oil supplies are not simply something the US government can print more of. I want to put the gravity of this situation in perspective. This was only the third time in the past 50 years that the IEA has released strategic reserves. The last 2 times it happened, it caused super spikes in the price of oil. This time, that's even more likely to happen because supplies from places like Norway and Mexico are tighter than ever. As investors and consumers, we have to take an objective look at this situation and decide how to best protect ourselves. Oil prices are persistently high and almost certain to go higher over the long term. Food costs are soaring. The Federal Reserve is printing a seemingly endless supply of dollars. The debate over the debt ceiling is far from being resolved. And the US labor market is stagnant, and the national debt just seems to grow and grow and grow. This seems like a recipe for disaster, yet politicians in both parties are so hung up on partisan bickering that they can't even begin to address the underlying problems. Not the least of these problems is the lack of any real energy policy. The United States has bent over a barrel, dependent on foreign oil to meet all our energy needs. And the days of cheap energy are over. As a result, we're seeing higher costs for everything that use oil or related products: transportation, manufacturing, industrial, construction, you name it. The bottom line is we all have exposure to higher oil prices, so we must invest in such a way to offset some of those costs and even profit from the inevitable rise. The most obvious ways to do this is with commodity futures and possibly options on individual energy stocks. But these vehicles are often very volatile. So I recommend energy ETFs and even ETF options if you want some more leverage. One fund to consider is the PowerShares DB Oil, ticker symbol DBO. It's a futures-based ETF that often tracks the spot price of crude better than the equity-based funds. But if you want to invest directly in energy companies, take a look at the SPDR S&P Oil and Gas Exploration and Production Fund, ticker symbol XOP. Oil companies have been raking in profits hand over fist for the last several years. So it stands to reason that higher oil prices will continue that trend. As a result, this ETF could be a real winner. I'm Kevin Kerr for Money and Markets TV. Thanks for watching.